Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bakra, European rate strategist, and I'm joined today by our global rate specialists, Giles Gale, Head of European Rate Strategy, Blake Gwynn, Head of Front-End Rate Strategy in the Americas, and Theo Chapsalis, Head of UK Rate Strategy. Given that we're less than a week away now from the US elections, I think that's probably the best place to start today. So Blake, update us on what your thoughts are heading into next week.
Yeah, sure. Thanks, Imogen. It's kind of crazy. We're actually this close now. It's something, at least on the US side, we've been thinking about for so long now. Can't believe we're actually this close to having some resolution on a lot of these issues. But I will say, there's really quite a bit riding on this election. Most importantly is the fact that the shape of any fiscal stimulus and the fiscal tailwinds that we're likely to see in 2021 and 2022 are going to be almost entirely dependent on the outcome. One thing I will say is that I do feel that people focus a lot on the presidential race, but in actuality, the Senate race is probably going to be a much more a potent factor for markets, given that both what I see as kind of the biggest risk on event and the biggest risk off event both happen under a Biden presidency. It's really about whether we get that split between the White House and the Senate, or whether Democrats are able to sweep. If they're able to sweep, I mean, Biden basically has a carte blanche to enact whatever kind of fiscal stimulus he wants in regard to the COVID crisis. And even beyond that, as we look at the next 2 years, he probably does quite a bit of spending on, environmental programs and a lot of the other kind of infrastructure-based stuff that he wants to get done. You compare that to what happens if it's split. And really, we probably end up in deadlock with pretty much anything they try to get done. So very, very stark outcomes depending on who takes the Senate.
Sorry, I was just butting in there to ask what actually is your base case then for the Senate?
Still for Democrats to take it, but it is still a very tight race. If you look at kind of what some of the markets have priced in, some of the odds markets, they still generally point to higher probability of Democrats taking the Senate. But there are some idiosyncratic things that can happen on various races that, that I think make it a little bit more difficult to call, say, than the presidential race, where we have a little bit more certainty, where a lot of, to the extent that there were polling errors or something, we would see that happen across a lot of the swing states. It makes the presidential race a little bit easier to call, but on any given state, various things could happen, particularly with how bizarre the actual voting process has been this year with mail-in voting or early voting and all these kind of new structures that are being tested out in real time. Anything could happen, but we still expect Democrats to take the Senate and for Biden to win.
So you say that the presidential race is a bit easier to call, and it certainly feels, like polls are giving a very clear message. Do you think the market's pricing in that? It feels to me like the market's a bit reluctant to price in as much as a Biden victory as polls are suggesting.
Yeah, you're totally right. I mean, I think even just anecdotally, a lot of people, when you talk to clients, when you talk to other people on the street about expectations for the presidential election, everybody is very, very quick to hedge. Normally, if we were to think about any other type of driver for price action, if I were to go to a trader and basically say, hey, look, you've got a 65% probability of something happening or higher, how would you like to position? I mean, I think that's a lean that I think most traders and risk takers would generally like to see. But in this case, I don't think people would be comfortable unless it was 90% in favor of Biden. And I think a lot of that goes back to 2016 and just how offsides a lot of people got caught in 2016. There's just a little bit still this kind of shell shock going on where I think people are very afraid of putting any kind of risk, and they don't trust the polling. They don't trust this narrative that Trump doesn't have a chance because it gives them shades of what happened in 2016. So I think heading into the election, even though, if you look at the polls, they point, I think, very clearly to a Biden victory. Everybody's going to be quick to give a caveat to that and say, and I think also the market and the news media are both kind of hungry for a a Trump surge story in these last few days, just because we've been on this kind of Biden lean for so long. I think they want a fresh storyline, if you will, or some kind of shift in the narrative into these last few days.
Okay, so one kind of trade that we've been talking about a lot is steepness, and do you think that position is crowded then, given what you're saying about, I guess, positioning heading into the election and what people are willing to believe and not willing to believe in the polls?
Yeah, I think saying steepeners is crowded is probably the most crowded trade. Everybody that you talk to will tell you that steepeners are crowded. But like we said, I mean, like we were just saying, I think a lot of people are very wary of this election. They're wary of another surprise like in 2016, and are playing things closer to home than all of the anecdotal evidence would suggest. So even though everybody says, yeah, steepeners are super crowded, if you ask, do you have max steepener on? Well, no, I'm going to be kind of neutral into the election. We don't really want any risk. We don't want to get, we've had a decent year. We don't want to get blown up into year end. So, we're playing it safe around the elections. And you get that a lot to the point where you start to ask, well, who are all these people that are, maxed out into steepeners? I do think it's popular trade. I do think it's a consensus idea. I just think that if you look at the actual money that's been put on the line for those trades, we're certainly not at max capacity. And I think after the election, if we do see a Democratic sweep, I still think there's room for that to move. I don't think, it's one of these instances where we're going to see buy the rumor, sell the fact, where everybody kind of loaded up onto it into the election. And then if we get the result that people are expecting, it comes back out. I think it's actually the opposite, that a lot of people want to be in steepeners, but just haven't really, are kind of waiting until the election result because they don't want to deal with that uncertainty.
Okay, and so just thinking a little bit beyond the election now, given that we have the refunding announcement, which is conveniently on the 4th, the day after the election, how does that kind of steepening theme fit with what you're expecting from that refunding announcement?
Yeah, the morning after the election is an interesting time. I mean, we're still going to be counting votes, and these guys have to give an announcement on supply. I mean, it's funny, you could either see that as a plus or a minus, because on the one hand, they're obviously it's a bad day where we could see a lot of a bad day to make an announcement, because we could see a lot of volatility that morning. But on the other hand, maybe it gives them some cover to do something, and that's actually what I'm expecting at this point. I think we have another round of increases coming. I think just from what I've heard and conversations I've had, it seems like that's probably out of consensus. I think most are probably expecting them to pause, both because of the proximity to the election, but also I think next year, if we don't get a large stimulus package, let's say we get that split where Biden, Senate GOP hit deadlock, nothing really gets done, government won't be spending a lot of money. There's a chance we could end up overfunded at some point in the next few years. But I think that's something that's very easy to deal with. Keep in mind, we've had massive issuance in bills this year. There's still a abnormally high level of bills outstanding in the market. So it'd be relatively easy to start cutting those back if we did end up overfunded. The risk in the other direction is that they don't raise coupons next week, and we get a massive stimulus package in January or February, and all of a sudden they have to turn around and start really, really ramping up debt issuance in a very short amount of time. And I think that could be more disruptive for markets than the risk in the other direction, which is they end up overfunded and gradually pare down bills or run a high cash balance for a few months in the summer or something. So I think if Treasury is going to be risk averse, I think they really should manage to that kind of worst case outcome, which is that they see a massive stimulus and have to fund it in a very short amount of time. I think that's the risk they should be worried about. And that says to me that they should probably do another round of increase in coupon auctions at this refunding. I also think they're probably going to increase tips for the first time since early 2019 was the last time they increased tips issuance. But they seem to kind of foreshadow that. They send around this refunding survey to all the primary dealers ahead of the refunding, and they asked a special question on increasing tips issuance, which is usually a pretty clear sign that that's something that's going to be on the table. And a lot of times they use that to kind of flag or to kind of foreshadow decisions they're going to make at the meeting. So yeah, it's one thing that's happened as they ramped up all of these other auction sizes for the last year is that they haven't really touched tips because tips had this huge liquidity breakdown in March and April. I think they've been a little afraid to increase supply. So what's been happening is this divergence between the amount of nominal supply and the amount of tip supply has been growing bigger and bigger. And so I think, at some point they need to start bumping tips issuance so that gap doesn't grow larger.
Okay. Theo, given you're our inflation specialist, probably a good time to bring you in here. What are you thinking about the refunding announcement and what that means for tips?
I think the very important point is the interplay between the amount of bonds that are getting purchased versus what is being issued. So basically the net effect. And what is very interesting is that any increase in tips, even with an increase, actually, the amount of issuance in tips remains a small fraction of what is getting issued in conventionals. Now, at the same time, when we look at the numbers at what is being purchased, the amount that is being purchased in tips is considerable. So one point that I think will make a lot of investors pretty much think twice before selling the market is Fed buying of tips. So basically, you've got a persistent buyer of this asset class. Now, when I look at my models and when I look at valuations across tips, this is clearly evident. So what you can see is that from a modeling point of view, you could even capture the moves in March and April, and you could, to some extent, explain that weakness in tips if you consider what is going on in volatility and what is going on in energy, for example. So in general, tips were broken, but also other parts of the market were broken. What we see is an exuberance in tips, a particular strength in tips, more than what would be justified by other risky assets. And to a large extent, this is really because of Fed buying. It is because of the support that is behind the asset class relative to no significant increase in tips issuance. So this is something which is very important that we should definitely keep in mind when we look at inflation valuations in the US. And it also explains why inflation expectations in the US are so much higher, or actually have risen, have rebounded from the March lows by a much bigger extent than what is the case in the Euro area or in the UK.
Okay, I'm just going to interrupt there and say when we say tips, we mean inflation-linked bonds in the US, just for anyone that's wondering. I know we said it a few times. Okay, so sticking with you, Theo, and sticking with the theme of supply, I guess, you've updated this week your expectations for gilt supply for the next couple of years. That's a theme that's been dominant really globally this year, given the size of the fiscal expansion and the deficits that we've seen in response to the COVID crisis. So what are you expecting next year? Is it going to be as much supply, or is the UK Treasury going to start to bring this down a bit?
So issuance will be a bit smaller. This year stands out because we expect basically the deficit to reach 17.5%, which is a record by all means. We need to go back to the 40s to probably have comparable numbers. Next year, we do expect a decrease. Nevertheless, we expect issuance to be more in the 230 billion area, right? So is this a high number for next year? Absolutely. It is smaller than this year. And I think at this point, I need to bring up three key themes in issuance. So one is what is going on at the front end of the curve and with regards to issuance of short gilts. And what we've realized is that gilts, the short proportion of gilts is getting shorter. And this is key. All that negative rate story supports basically the issuance of shorter dated gilts. There is an investor base that wants to buy short dated gilts. So this is one theme, that the short gilts are getting shorter. We can see that this is consistent. We have new 3-year lines, we have new 4-year lines, etc. Point number two is the proportion of shorts. And we can see that the DMO, so the UK Debt Management Office, the issuer, is issuing more and more proportion of debt in short maturities. And this is interesting. So while you may see fiscal numbers and more fiscal expansion, etc., and more issuance, this happens at short maturities, which can be easier absorbed. Now,
does that imply scarcity value to the back end of the curve then?
Yeah, I think it's this is also what we think could be in the long term, that while you do have issuance and while you may have, a market which is significantly supplied, the back end of the curve is not supplied to that extent. This is important, and thanks for bringing it up, Imogen. It goes very well together with the point on linkers, and the proportion of linker issuance is also being reduced. And linkers are pretty much the cousins of long conventionals. They are long dated debt instruments. So long linkers are also issued to a smaller and smaller extent. Basically, from the issuance point of view, while you get more supply, and while we factor in significantly high numbers, so we expect numbers in the area of 230 to 240 billion gilts being issued next year. Still, this does not mean that there should be a significant structural pressure at the back end of the curve.
Okay, cool. So let's switch gears and move over to Europe then, because it felt like supply was really the theme a few weeks ago, and that was what was driving markets. But actually over the last, 2 to 3 weeks, it seems like all European markets can focus on are worsening COVID trends, really. Giles, what are we thinking about those?
Yeah, well, I mean, that's perfectly timed question, because the guy blowing leaves outside my window has just started again, so I hope that won't distract too many people. Listen, yeah, I mean, it makes it very difficult, doesn't it, to really have a view. If your experiences in markets are not dominated by such things, but I think we started off this discussion with the other big theme in the world, which is the US election. And actually, in Europe, as far as European markets are concerned, it's been absolutely eclipsed by what's going on in COVID trends. And of course, we're just subjected to this relentless flow of negative headlines, and this endless focus on the latest terrible figure and so on. And I think it's going to be very difficult for us to bust out of that dynamic really in the near term. I mean, today, for example, it looks like what we're going to see is that the existing strategy of trying to do things on a sort of tactical, localized basis to try to limit the economic impact of lockdowns as far as possible is going to give way to more national strategies in that. So that it looks like we might get announcements from Germany and France, and by the time you listen to this, that might already be in place. We've also got Spain debating its state of alarm in Congress as well, and obviously that's the first step towards a more national strategy there as well. I mean, I think that what we're going to see is lockdowns that will be a lot lighter than in the springtime. So people will still be encouraged to go to work wherever they can, and kids will still be allowed and encouraged to go to school. So a whole lot better. We're probably just going to see people being told that they should try to limit their leisure activities as far as possible. And so in a sense, it's a sort of glorified curfew. Is that priced in? I mean, my sense is yes, it is priced in, which means that I think that actually markets have probably done pretty much as they need to in terms of I guess the risk off move that has pushed European interest rates down and down and down, and we're now as low as we were, well, I mean, pretty much at any point since the crisis.
Great. I guess that means that there's a lot for us to look forward to in the next week then, and when we record this next week, there'll be a lot to update on. I hope you enjoyed this episode of Bondcast. Please do subscribe to our channel to get future episodes and like it, as this will help others to find it. We also encourage you to follow us on social media to get all our latest content. Speak to you again soon.